Welcome back. Let's get a corporate conversation going now. Tamilnad Mercantile Bank reported its Q4 numbers. The net interest margin has come under pressure at 4.49%, and slippages too have gone up on a sequential basis. To discuss the way forward, we're joined by the Managing Director and the CEO of the company, S Krishnan. He's with us on the show now. Mr. Krishnan, morning. This is Rima here, and apologies for keeping you waiting. First, could you talk about the increase in your slippages? Sequentially, they've gone up from 50 crore to 70 crore. What led to that, and what would be the annualized slippage ratio going ahead? What can you guide on slippages, sir?
Okay. See, if you look into sequentially, the slippage has gone up in the sequential quarter, but not very high. I will only request that look into the slippage ratio of the bank for the year 22-23, which is just 0.82, and the credit cost with 0.40. In fact, this slippage is on account of one single account which has contributed to that. Otherwise, I do not have much of the pains. If you look into my stressed assets, that is the SMA also we could able to bring down considerably from 12% year on year to 6%. That is what I have to say. And within that 6.51% of SMA, my SMA2 is just 1.27%. So overall, if I look into the slippage is very much under the control with a total slippage ratio of just 0.82%.
You said one account led to the high slippage. Can you quantify that account? I mean, and what was the value of that slippage?
No, well, the slippage is around 25 or 27 crores of that single account, which increased this one. And overall, if you look into it, it's not a big number.
Got it.
Okay, sir, just want to understand now. If I look at your net interest margin, it's come down a little bit quarter on quarter. Well, it's more or less stable year on year. The cost to income ratio has increased 43.14 versus it used to be 39.2 last year. Even quarter on quarter, the cost to income ratio is down, is increasing. So can you give us the rationale here? Why is the cost to income ratio going up, whereas margins sequentially are coming down? A lot of other banks are actually reporting improving margins.
Okay. Now, if you look into the net interest margin, the net interest margin year on year, if I look into, it has only improved. The net interest margin has gone to 4.46 on an annual basis from 4.1, that is an increase of 36 bips. When I come to the cost income ratio, the cost income ratio again on year has marginally come down. I can say it is flat from 4.29 to 42.29 to 42.24 on a year basis. So the net interest margin of 4.46, I feel that is good. In fact, last time when I met you and gave the guidance, I was telling that we will be maintaining a NIM of 4+, and we have been able to increase from 4.1 a year back, that is on March 22, to 4.46 this year.
All right, and what would you expect going forward on the net interest margins? Do you expect it to hover in this range of around 4.5%?
I will be hovering around this range, rather as a very conservative, since I say that definitely I will be maintaining 4+, more or less I will be hovering around this.
Got it. Mr. Krishnan, just one question on your loan mix. You know, in Q3, when we got the figures, it looked like you're bringing the corporate book down. But now in Q4, we're seeing a 10% growth year on year. You have the 30% growth sequentially. Can you tell us what's led to that and what is the plan on the corporate book?
See, no. If you look into, the base is small, so the percentage gives a different meaning. If you look into, today I have a RAM of 87%. And the corporate and others is only just 13%, which was 89% in Q3. And in Q3, the same question came. In September, it was 87 or so. And I said that some of the corporate which got matured at the end of December, that is why it has come down. And I also said that we are open with taking up the good corporates. Accordingly, we have taken good corporates in our book, some AAA like that. So, and overall, if you look into just 13% of corporate is still I feel that the mix may vary little.
So very quickly, did you restate your Q3 numbers in terms of margins, slippages, return ratios?
No, I saw the feet of Mr. Abhishek. I think it was basically what has happened is, let me clarify. Last time what was given as it came in the case of NIM and ROA, if I'm right. While giving for 3 months, it was given as the cumulative for 9 months and annualized. That is how the mistake has come. I apologize for it.
Okay. Thank you, sir.
In fact, I should thank you for pointing out.
Okay. Thank you very much, sir, for clarifying that. That's Tamilnad Mercantile Bank. Look forward to chatting with you through